This is a presentation on Chapter 13, Stockholders' Equity, and we're going to be talking in Learning Objective 5 about how to prepare a corporate income statement, including earnings per share. So this is an exhibit that shows a income statement for Kevin's Vintage Guitars, Inc. So the information on this income statement we're going to discuss in more detail in the following slides, but I just want to point out to you some of the information that we're going to cover. So on this slide, it gives us information on the operating income for the company, then again on the sale of equipment, and then the income taxes, and we get a total called income from continuing operations. So for this company, it's $71,100. It also has a separate section for discontinued operations. And if you notice, discontinued operations are reported net of the applicable tax. So net of tax, because the income tax expense has already been calculated on the income from continuing operations. So I wanted to make a point of mentioning that. Also, if you notice on the corporate income statement below net income, we have earnings per share, and the earnings per share is also going to be reported separately from continuing operations and from discontinued operations, and then for the total for net income. So earnings per share is required to be shown on the face of the income statement, and it is required to be reported separately for continuing operations and discontinued operations. So what do we mean by continuing operations, that first section from Kevin's Vintage Guitars, the $71,100? Why is it important to separate that? The reason why is that the income statement helps investors make predictions about future earnings. So if there is income that is coming from part of the business that's not going to continue in the future, we don't want the investors to be misled. So the income that Kevin's Vintage Guitars shows from continuing operations should be a good indication or a good predictor of what they are going to be earning in the future, and that's important to investors. So what is discontinued operations? Well, when a company sells or disposes of what we call an identifiable division, sometimes they call it a segment of the business. It has to meet certain criteria to be able to be considered discontinued operations. That means that they have ceased that operation and they've sold that part of the business. And so that gain or loss is not going to continue in the future. So that's the reason why we separate it, because we don't want to mislead investors. Now, we noticed when we looked at the income statement that it was net of tax. So the tax rate in this case was 21%. So you multiply the income, if it's income from discontinued operations, by the tax rate, and then you report it at that net amount. Now, if it had been a loss, then you would also multiply it by the tax rate, and that would actually be income tax savings on the loss. So that reduces the loss. You might have noticed too that there were some gains and losses on the normal sale of plant assets, and those are not considered to be discontinued operations. Companies buy and sell pieces of equipment all the time, so those are not required to be reported as discontinued operations, but they should be reported under the other income and expenses category as they were on the income statement for Kevin's Vintage Guitars. Okay, earnings per share that we saw at the bottom of the income statement is probably one of the most widely used of all business statistics, and we're going to talk about how you calculate or use earnings per share to calculate the PE ratio in a later part of the of the presentation for this chapter. So what earnings per share reports is just either the amount of the net income or the loss for each share of the company's outstanding common stock. So it's just per share, as it says. Now, because it's only for common stock, when it's calculated, you have to subtract any preferred dividends from net income. And then it's divided by the weighted average number of common shares outstanding. So it's actually quite complicated to calculate earnings per share for a large corporation. They're also required to report diluted earnings per share, which is even more complicated, but that would be covered in an intermediate accounting class. This is the end of the presentation for Learning Objective 13.5.